Something happened in the silver market on December 11, 2024, that should have sent shockwaves through every financial institution on the planet, but most people missed it completely. For the first time in history, silver touched $64 an ounce, then crashed back to $62.70 within just 12 hours. But this wasn't just another volatile day in precious metals. This was stage 3 of a 4-stage commodity squeeze pattern that has destroyed governments, bankrupted nations, and transferred trillions in wealth from the unprepared to the prepared throughout history. The data is screaming at us. In just 4 business days, COMEX registered silver inventory plummeted from 48 million ounces to only 19 million. That's a drain rate 145 times faster than normal. When the physical backing for a market evaporates at this speed, we're not just looking at volatility. We're re-witnessing the early stages of a supply crisis that could make the famous 1980 silver squeeze look like a dress rehearsal. And this time, the smart money isn't fighting the squeeze, they're driving it. This is stage 3 of the 4-stage commodity crisis pattern, a pattern that has repeated throughout financial history. I'm going to show you exactly how this pattern destroyed the London Metal Exchange in March 2022, why the COMEX could hit 0 registered silver ounces by late January, and why JP Morgan just flipped from being massively short to net long silver futures for the first time since 2018. Understanding this pattern does just explain what's happening to silver. It reveals the mechanism by which physical reality eventually destroys paper promises in every rigged market. It all starts with stage 1, artificial supply and price suppression. This is how every commodity crisis begins. Financial institutions create a massive artificial supply through paper contracts, while systematically suppressing prices to keep regular investors from buying the physical asset. From 2008 to 2023, the silver market was the perfect laboratory for this manipulation. For 15 years, big banks have been selling silver futures contracts with absolutely no intention of ever delivering the physical metal. Here's how the scam worked. The COMEX allowed unlimited paper contracts to be written against a very limited physical inventory. In a normal market, contracts are backed by the actual stuff. But in the silver market, for every 1 physical ounce that existed, over 300 paper ounces were being traded. JP Morgan was the architect of this system. From 2008 to 2023, they quietly accumulated over 1 billion physical ounces of silver. At the same time, they were selling huge amounts of paper futures to keep the price down. Every time silver started to rally, JP Morgan would dump thousands of contracts, often during low-volume Asian trading hours, crashing the price and scaring off retail investors. They were building the largest silver hoard in modern history while convincing the world that silver was a worthless investment. The manipulation was so blatant that in 2020, JP Morgan paid a $920 million fine for spoofing the silver markets. But for them, fines are just the cost of doing business when you're making billions from price manipulation. That fine was roughly what they made in just 8 days of trading silver. Now, while the banks were busy suppressing the price, something was happening in the real world, hidden in plain sight: an explosion in industrial demand. In 2024, solar panel production consumed 234 million ounces of silver, that's up 18% in a single year. Electric vehicle manufacturing used another 78 million ounces, up 22%, and the data centers needed for AI infrastructure consumed 41 million ounces, a staggering 37% increase. This isn't investment demand that might come back to the market. This is permanent consumption that removes silver from the system forever. The math simply became unsustainable. Global mine production was stuck at around 813 million ounces a year, but industrial consumption surged past 1.2 billion ounces. The gap was being filled by recycling and drawing down existing stockpiles. But recycling can't keep up with this kind of tech demand, and those stockpiles are not infinite. Stage 1 created the perfect trap. Low prices convinced most investors that silver was a boring asset, while industrial demand was quietly eating up all the available physical supply. The smart money bought the real metal, while the masses bought paper ETFs that were backed by little more than a promise. This leads us to stage 2. Supply chain stress and early warning signals. This is the period from 2021 to 2023. Stage 2 begins when the physical supply starts showing serious stress, even while the paper manipulation continues. The early warning signals appear months, sometimes years, before the mainstream financial media even notices something is wrong. The first cracks began to appear in 2021. Industrial users started reporting delays in getting their physical silver. Solar panel manufacturers were facing 2 to 3 month wait times for silver paste deliveries, something that was completely unheard of in the industry. Electronics companies began buying their silver supplies far in advance at premium prices, just to guarantee their production lines wouldn't shut down. Then, a crucial signal emerged. The Shanghai Gold Exchange started trading silver at a premium to the London spot price. This meant that manufacturers in Asia were willing to pay extra for immediate delivery of real, physical silver, while Western markets were still trading paper contracts at artificially low prices. This price difference, this divergence, is the market screaming that physical reality is breaking away from the paper fiction. Something is happening in the silver market, and it's happening fast. What I'm about to share isn't speculation. It's a series of interconnected events that suggest we're on the verge of a historic price movement. The signs are no longer subtle. Major institutions and central banks are making moves that signal a massive supply crisis is imminent. It all started quietly. We saw central banks around the world start accumulating precious metals, not just gold, but silver too. Poland bought hundreds of tons of gold. Turkey boosted its reserves, and China simply stopped reporting its data, which is historically a sign of massive accumulation. When the world's biggest financial institutions lose faith in paper money, they run to physical assets. Then, the cracks started showing in the ETF market. The iShares Silver Trust, the world's largest silver ETF, had to change its prospectus in 2021. They warned investors that they might not be able to source enough physical silver to back their shares. Think about that, an ETF whose entire purpose is to hold the physical metal admits it might run out. This wasn't a small warning, it was a fundamental breakdown in the supply chain. Fast forward to just last week. In the first week of December 2024 alone, the iShares Silver Trust saw its holdings increase by a staggering 590 tons. But this wasn't driven by small retail investors like you and me. These were massive institutional flows. When major funds are moving hundreds of tons of silver in a matter of days, it's because they know something the rest of us don't. The velocity of this accumulation is a clear signal that the smart money is positioning for a supply crunch. And that brings us to where we are right now, the inventory collapse. This is the stage where the paper games can no longer hide the physical reality. Between December 4th and 8th, something unprecedented happened at the COMEX, the main exchange for metals futures. The registered inventory that's the physical silver available to back futures. Contracts plummeted from 48 million ounces to just 19 million ounces. In 4 days, that's a drain of 29 million ounces, happening at 145 times the normal daily rate for 2024. Why is this so critical? Registered inventory is the silver that sellers must deliver to settle their contracts. If they can't, they face unlimited losses. Right now, open interest in silver futures represents claims on about 600 million ounces of silver, but the COMEX only has 19 million ounces in the registered category to deliver. That's a 31-to-1 ratio of paper claims to physical metal. The math is becoming impossible. In any other market, this would be a full-blown crisis, triggering defaults and emergency rule changes. And then came the bombshell signal from the biggest player on Wall Street, JP Morgan. For 15 years, they held a massive short position in silver, all while quietly accumulating one of the world's largest physical stockpiles. But their November 26th commodities report revealed they have flipped their position. They are now net *long silver futures for the first time since 2018, when the most powerful trading desk in the world abandons a 15-year strategy. They aren't guessing, they see the writing on the wall. They know the physical market is about to overwhelm the paper market they helped control for so long. The options market confirms this. We're seeing heavy call buying at strike prices of $65 and $70 for January and February 2025. This means big money is betting that silver will surge 15 to 20% higher within the next 60 days. On top of all this, for critical market indicators are flashing red, all at the same time. First, silver lease rates. The cost to borrow physical silver have spiked to 38% annually. High rates mean physical metal is scarce. This has only happened 3 other times in 20 years, and each time a major price rally followed. Second, the market is in backwardation, meaning spot silver for immediate delivery is more expensive than silver for future delivery. This is a classic sign of extreme supply stress. Third, Shanghai silver prices are trading above London prices. This shows that Asian manufacturers are desperate for physical metal and are willing to pay a premium for it right now. And finally, the Federal Reserve just cut interest rates. With more cuts projected, this creates negative real yields, a condition where precious metals historically thrive as investors flee currency debasement. All 4 of these indicators firing at once has only happened twice before, in 2008 and 2020. Both times, silver rallied more than 40% within 6 months. The evidence is overwhelming. This isn't just another rally. The structural integrity of the silver market is breaking down. We are now entering what could be the final stage of the silver market as we know it, Stage 4, the systemic collapse and rule changes, projected for 2025. This is where the math simply stops working for commodity exchanges, forcing them to rewrite the rules to avoid a complete meltdown. And historically, this stage is what ignites the most explosive price moves, as paper manipulation finally gives way to physical reality. Let's look at the COMEX, the primary futures exchange for silver. If their registered silver inventory continues to deplete at just half its current rate, we could see it hit zero by late January 2025. This has never happened before, an exchange with zero physical metal to back its contracts. What happens then? They have 3 options, and all of them are incredibly bullish for silver. Option 1. They honor all delivery requests. This forces anyone short on silver to go into the open market and buy physical silver at any price to deliver it. We'd see a mad scramble, likely driving silver well past $100 an ounce, as industrial users fight with investors for the last scraps. Option 2, they force cash settlement. The exchange simply says, sorry, no silver for you. Here's cash instead. We saw this happen with nickel on the London Metal Exchange in 2022. The paper price would crash temporarily, but the physical silver market would detach, trading at a massive premium. Eventually, the paper price has to chase the physical price, leading to a much higher valuation. Option 3, an emergency injection. A central bank or government could step in with their own silver to prevent the market from breaking. This happened during the famous Hunt Brothers squeeze in 1980. But there's a problem. Government stockpiles are a shadow of what they once were. There may not be enough silver to put out the fire this time. Now, many people will bring up the Hunt brothers who tried to corner the market in the late 70s, but today is fundamentally different. Back then it was two individuals driving the squeeze with speculation. Today, it's a global movement of institutional investors, industrial giants, and a genuine supply deficit. In 1979, there were huge above-ground stockpiles. In 2025, we're coming off decades of deficits. The rule changes in 1980 were targeted at specific people, trying to change the rules against giants like JP Morgan or BlackRock today. That's a whole different political ballgame. So what could 2025 actually look like? I see three main scenarios. The first, with about a 30% chance, is a parabolic squeeze. COMEX inventories drop below 10 million ounces. Industrial buyers panic and lock in long-term contracts, and silver skyrockets to between $85 and $95 by June the 2nd. And most likely scenario with a 50% probability is a more measured rally. Silver climbs to the low 70s by March, consolidates, and then grinds higher towards $80 as ETF demand picks up. The third scenario, about a 20% chance, is a correction. Maybe Chinese demand disappoints, or the Fed gets unexpectedly aggressive. Silver could peak around $70 in the next month, then pull back to the 50s before the next leg up. But here's the key difference between this and any past rally. This isn't just about money, it's built on a foundation of unstoppable industrial demand. Solar panel production alone needs 250 million ounces a year and is growing fast. Electric vehicles need silver, AI data centers need silver. And for these applications, there are no good substitutes. This means demand is incredibly inelastic. Solar companies will pay $80 silver before they redesign their entire product. This industrial backbone is what makes this a sustained rally, not a speculative bubble. It's the combination of inelastic demand and a finite, shrinking supply. What does this all mean? The silver squeeze is more than just a trade. It's a powerful signal that physical reality is reasserting itself over financial promises. When the paper can no longer be exchanged for the real thing, it shakes the foundation of trust in the entire financial system. What we're about to witness could change everything. Have you ever wondered what happens when a promise can't be kept? I'm not talking about a small, everyday promise. I'm talking about a promise made in the financial markets, a promise that underpins trillions of dollars. Right now, there is a situation developing in the silver market that could be the canary in the coal mine for our entire financial system. It all revolves around an exchange called COMEX, which is supposed to deliver physical silver to people who hold silver contracts. But what if they can't? What if their physical supply runs out? This isn't just about silver, it's a huge red flag. If COMEX can't deliver silver, what does that say about other commodity exchanges, or the treasury bond market, where major countries like China and Japan are selling off their holdings, or even the US dollar itself, whose status as the world's reserve currency is being questioned? We're witnessing a massive shift. Investors are losing faith in paper promises and are moving towards real, physical assets. Think about it. Central banks are quietly buying up physical gold, and major institutions are abandoning market positions they've held for over a decade. When the big players start making moves like this, it's time to pay attention to what they do, not what they say. This could be your key to financial survival. This isn't a news story. We've seen this pattern before. In 2020 with palladium, and in 2022 with nickel, a four-stage cycle plays out: manipulation, physical depletion, price explosion, and finally, market breakdown. Right now, silver is accelerating through stage 3, and stage 4 is right around the corner. The next 60 days are absolutely critical. We have a Federal Reserve meeting on December 18th that could push precious metals higher. Then, on December 26th, the December futures contract expires, which will be a major test for COMEX's ability to deliver physical silver. If their inventory keeps dropping at the current rate, we could see critically low levels by mid-January. Then another stress test comes with the January contract expiration at the end of the month. The timeline suggests that sometime between January and March of 2025, the breaking point will be reached. This is the end of a 40-year experiment where paper promises tried to replace physical reality. But you can't build solar panels with paper silver. You can't put digital silver into electronics. When paper manipulation hits the wall of physical reality, reality always wins. The silver squeeze is just getting started. The question isn't if it will continue, but whether you'll be positioned to benefit from this historic shift.